want to do is I want to say, let's say if things do crash, if things do really, if the shit really does hit the fan, as they say, okay? If that happens, where do I want to be right now? Or where do I want to focus on to be able to make the most money in the real estate business? And this is why I love real estate, is because you can make money in down markets like this. Welcome to the Wealth Webinar Wednesday series. My name is Stephen Nagy. Today is October 19th, and today I'm filling in and hosting the Wealth Webinar for Chris Naugle. Chris, unfortunately, his sister passed away this week, and Chris is in Buffalo with his family, and always family first. So as much as Chris wanted to be here, pumped up and ready to share with you guys from everything that happened with the pre-MC launch and over the weekend at the experience. Of course, family first. So Chris is with his loved ones right now, honoring and celebrating the life of his beautiful sisters. So Chris, our hearts and condolences and prayers are with you by all means. But the show goes on, and our team is like family. So we're going to rock this thing today and have a good time. So today, what I decided to do was kind of a little bit of a continuation from last week. So if you were with me last week, then you're going to be caught up on things. Last week, we talked about what is money school and, why are you here? So basically last week, we went through, all the different places that money school can help, how we look at money, how we look at your different types of money, how we can start avoiding the three wealth killers like taxes, inflation, and volatility. And we really got pretty in depth with that last week. Okay. And of course, all these recordings for all the Wealth Webinar series can always be found on the Chris Naugle YouTube channel, or you can just shoot right over to YouTube at the Chris Naugle and watch all the recordings, including this one, on the YouTube channel anytime. And while you're there, make sure you subscribe and ring the little bell. That helps us with all the algorithms. And we are putting more and more time and money and effort into growing YouTube and using YouTube as a source to get our information out there. So appreciate you guys helping us with that and just going over to the YouTube channel, hitting that subscribe and that like button. All right. So today what we're going to do is we're going to really dig deep into the real estate portion of Money School. So I kind of named today why real estate and why now. Real estate is something that I've been passionate about for a very long time now, ever since I was introduced to it through a seminar that I actually attended originally. And ironically, my journey in real estate started actually before that. When I was in college, actually, one of my electives was a real estate course on how to become a realtor and just some basics about real estate and houses and what that looks like. It was based around getting your real estate license, but it was a college course that I took, which I think is kind of interesting and pretty cool at the same time. And that introduced me to real estate and kind of got me my first start in it. I actually did a little bit of real estate work up in Southwest Virginia, where I went to college, but then I kind of forgot about it because it wasn't something I wanted to do long time. I knew I didn't want to stay in that area. So when I moved down to South Florida and became a certified financial advisor with Ameriprise Financial, it brought me to the other direction. The financial advisor world, traditionally speaking, is the stock market. So investing in things like mutual funds and long-term planning through insurance, the traditional way of using insurance, not the way that we use insurance, and all those things that financial advisors talk about. And so I did that for a couple of years, and then I was introduced again to real estate, but on the investment side. And so when I look back at, my introduction to real estate in the realtor world, and then my experience being a financial advisor with Ameriprise Financial, when I started learning about real estate investing, business, entrepreneurship, and really everything that goes along with that, like controlling your life, it all started to click for me because I had seen the traditional way of doing things. I saw how the majority of people look at, investing in money and, letting other people do it for them. And then I saw from this side of the point where, hey, I can control this in my life. So that was kind of my quick journey on how I got started with this. And, a lot of you guys know that story from there. From there, I, went to a seminar, learned about real estate investing, got into that business, started doing it with my business partner, Brent, who's my cousin to this day. my cousin to this day, my business partner to this day. Of course, he's still my cousin. And so we started doing some deals and whatnot. I started really traveling, teaching, digging in more and more, building the connections. And, that was about 14 years ago. And I've been doing it really ever since for the most part. And so real estate's always been a foundation. And so when we look at money school and what money school is, and we talked about this last week. So money school really consists of three parts: real estate, money, and legacy or generational wealth, or kind of what the dreams are for a lot of people. And so, this is really the foundation when it comes to everything that we do when it comes to money school. This is what we call the foundation. And last week we talked a lot about the money side. So again, the three wealth killers, the reason why we're going to use this foundation is to avoid the three wealth killers and create financial success for ourselves. So the three wealth killers: inflation, taxes, and volatility. So those three wealth killers are what really drive the majority, 95% of Americans, to never be able to achieve financial success when it comes to retirement, or at least whatever retirement looks like to you. And so what we do is we use the foundation for money school to start eliminating these three wealth killers from our life to allow us to be able to achieve our goals and dreams. And so, like I said, last week, we focused a lot on the money side of things. So if you remember, there was three, do everything in groups of three, right? So if you remember last week, there was three types of money that we looked at and how we can maximize the use of each one of those three categories when it comes to money. Do you guys remember what those were? Number one, qualified funds. So those are our IRAs, 401ks, Roth accounts, whether it's self-directed or not. Obviously, we talked a lot about self-directing last week, but that's one of the areas of money, right? Number two, we have IBC, the infinite banking concept, or the money multiplier, but this is the specially designed and engineered whole life insurance policies where we're going to funnel our money through to become the bank. Again, the reason why we use whole life insurance is because when we look at what the perfect investment is, a whole life insurance policy basically fits that mold. And so again, go back last week and watch that, or I can send you some resources if you want to dig in more on that part. But just remember that that's why we're doing this, because infinite banking, running our money through our own bank instead of somebody else's bank, making our family rich instead of somebody else's family rich, allows us to control the money, and it allows us to do two things at one time. It allows us to take advantage of uninterrupted compounding, guaranteed tax-free growth on our money at all times, while simultaneously we can take the money out of there even while it's compounding and growing, and use that money for other things: expenses, debts, investments, purchases, whatever the case might be. But we're able to do both of those things simultaneously. And when you look at two laws of wealth, taking advantage of compounding interest, as well as constantly keeping our money moving, making more money, this policy allows us to do both of those things at the same time. And to do one of these, to start your own banking system, to start a life insurance policy, you don't work any harder, you don't work any longer, you don't take on any more risk. You're just making one change, and that's where your money goes first. So instead of each month putting your money into someone else's bank, you're putting it into this policy that's acting as your new banking system. So number one, we want to take full advantage of all taxes through qualified funds, retirement accounts. Number two, we want to run as much money as we can through our own banking system to take advantage of all of that. And then three, when it comes to money, is leverage. So if you guys remember, we talked about things like HELOCs and home equity loan agreements. And HELOCs and different ways to leverage what we already have, leverage our money. Remember, and this is going to be a direct tie-in for what we're doing right now with real estate. One of the reasons why real estate is so powerful is because we can use leverage in real estate, meaning I can go purchase and obtain control of $100,000 property right now for $10,000 to $20,000, 10 to 20% down from a bank, for instance. I can go get a mortgage, or I can go get lending from somebody, from a hard money lender, from a private money lender, where I can obtain that property with sometimes none of my own money. A lot of deals out there get done with none of my own money. So talk about leveraging, that's just leveraging my experience, not my money. So, but these are different ways we can leverage. We can, pull equity out of our home through a HELOC or a home equity agreement and all this stuff. So this is everything that we hit on last week, was the money side. So just wanted to kind of do a quick review of that. So now we're in part two. And one of the other foundations of real estate, or of money school, which is real estate. And then the legacy aspect, I don't know what we're doing next Wednesday. Maybe we could dive deeper into that. But the legacy aspect is really going to be combining these two foundational pieces are going to make up and create the legacy for you in the long term. And we can get more into that, and we can talk more about like asset protection using trust and foundations and charities and all these different things to really create this legacy piece. But at the end of the day, these are going to be the foundational elements that build into this legacy long term for you. So that's why we need to concentrate and focus on getting these going. So let's talk a little bit about real estate. If you own real estate, put an I in the chat box. If you own real estate, okay. As you're doing that, if you own investment property, so meaning not your primary home, but if you own a home that you're making money on, so a rental property, something of that nature, where you're making money off of real estate, put RE in the chat box. RE if you have an investment property also. All right, so a lot of people own real estate. It looks like we have a lot of people that own investment real estate, which is awesome. So yeah, so there's got to be something to it, right? And so I always look back to my teachings and learning from other people. And I don't have any of my Rich Dad, but if you see my other bookshelf, which is back behind this desk on the other side of the office here, it's full of real estate books. It's full of Robert Kiyosaki and some of the old school trainers and teachers and just different books that I picked up over the years and different trainings that I've attended and courses that I've been through. And I got a bunch of stuff blocking it right now. I'll put a picture on social media soon of all the different books that I've collected. But it's the number one thing that I would say, especially if you're new to financial education, is start a financial library. So start buying books, audio books, taking notes, building notebooks, write in your notebooks and start stacking those up, trainings that you attend, any kind of material you get, and keep it. There's things that I still refer back to years later. Like this is a book when I was a financial advisor a long, long time ago called The Dream Book. And this is what we would go through with people. And we would just ask them, what are your dreams? What does retirement look like for you? The whole idea of this was to get people thinking about their retirement, thinking about their dreams. So then we could sit down and we could start creating a plan to get them to where they need to go. And the reason I show you this is not because it's something that I use today, but it's something that recently we were building a new program for you guys. It's called the Blueprint. And then along with that is going to be something called a personal CFO that you're going to receive. And so what I did is I went back and I pulled this out because I knew I had it. And this was a big impact on my life back then when I was just learning on my financial journey on what all this stuff looks like. So I pulled this out to start using it. And then I had a couple other notebooks from back when I used to do a lot of foreclosures and short sales and pre-foreclosures and was working with homeowners that were losing their houses, because I'm starting to re-familiarize myself with stuff I did 10 years ago. Why am I starting to refamiliarize myself with that? Is because the market is repeating what happened 10 years ago. We're starting to see this stuff happen. So I'm able to go back and refresh myself. I haven't done it in a while. And when you don't practice something for a while, you don't do it for a while, you forget, just plain and simple. There's a lot that goes into real estate investing. Don't get me wrong. And if you're not doing it every single day, then there's little things that you might forget. So building that financial library becomes very, very important. And so what we want to do is we want to start looking at, okay, where are we right now in the real estate market? And, what's happening? What happened in the past? Is it going to mimic that? Is it going to look different? So that's what I wanted to talk about for a few minutes here right now today, is what this real estate market looks like. Over the weekend, I had an opportunity to talk to several real estate investors that were in attendance at the Experience Mastermind. And over the last several months, I've really been kind of asking those hard questions, especially with some of our bigger borrowers on Private Money Club and some of the bigger borrowers that I have in my network. And so just studying, what do they think? What do they see happening? Talking to all the realtors that I know and the connections all across the country. What are you seeing? What are you feeling? So just in the chat box, what are you guys seeing in your personal areas? Are you seeing the real estate market continue to boom? Are you seeing the real estate market pulling back and slowing? Are you seeing the real estate market just kind of level right now? I'm just curious, what are you seeing in your market right now? If you put that in the chat box, and then I'm going to pull up a couple things to share with you all that I found. All right, so read a couple of these: leveling, level to slowing, pulling back and slowing, more days on market, so many price adjustments. Slowdown is stable. Pulling back in Charlotte, declining slightly, slowing in Massachusetts, slowing North Florida, slowing down. Okay, so it looks like almost everybody is either slowing down or leveling out right now. More days on market in Dallas, slowing down in the suburbs of Buffalo, repeat of 2008, Dexter's saying, cooling down, more days on market. Okay, so across the board, not a single person is in a current rising market or a hot booming real estate market in their area. Hey, that's what I'm seeing as well. That's what I'm hearing as well. Donald said more foreclosures coming. Okay, all right. And foreclosures are kind of what we're going to talk about next as well. So, but we can all agree right now that we have a slowing of the real estate market. Now we can look at data on that. Data tells us this morning that there are right now 49% less mortgage applications in 2022 than 2021. So just in 1 year, we're 49% down on new mortgage applications. Now, given 2021 was a historic year for mortgage applications, why? Because mortgage rates were at historic lows. Why? Because the Fed dropped levels to zero, started buying everything with quantitative easing and making money essentially free for the banks. The banks had to lend that money out, so they dropped rates as low as they've ever been in my lifetime. And everybody went out and bought new homes and upgraded and refinanced, and it drove the market up. And then along with that, obviously everything else that the Fed pumped into the economy, and everybody was killing it and just drove prices up and up and up and up and up and up and up. And we'll see that in a second on some of these charts that we're going to look at. So let's look at the actual data on this real fast. All right, so a lot of what we talk about is driven by something called the federal funds rate. Okay, so the Fed has been in the news a lot lately. You hear it that they keep increasing rates. So the Federal Reserve basically controls interest rates when it comes to the banks, because the Federal Reserve, what they essentially do is they lend money to banks and they control that bank overnight rate that they charge. So when banks have money, they know what they're going to pay for that money, and then they know what they need to lend it out for to make that spread. And so when rates are zero, banks are able to lend money out very cheaply, but essentially that's what the Fed rate is. So as the Fed funds rate increases, the cost for banks to borrow money and use money is more. So that's why you see things like mortgage rates and car notes and credit card interest and everything goes up right along with that. So that's one thing that we need to keep an eye on, is as these rates continue to increase, mortgages are going to increase. And remember, when a mortgage increases, the monthly payment for that property also increases. We've done some examples where we show you, hey, a 2% increase on a mortgage is going to be the difference in like $500 to $1,000 a month. Like, it's a huge difference. So somebody that can afford $2,000 a month, if all of a sudden that same home now costs them $4,000 a month, well, they can't do that. They can only afford $2,000. So if that was a $300,000 home before, well, now staying at $2,000, maybe that $200,000 is that $2,000 payment because of the higher mortgage rate. So they can no longer afford a $300,000 house, but a $200,000 house. So the whole market has to come down and adjust to what people are able to afford to buy. So as mortgage rates increase, home prices are going to have to come down just to allow people to be able to afford homes that are buying them. So that's why we're going to see that correlation there. So let's take a look at a couple of these charts just to give you an idea of what I've been looking at here. All right, so this is the first one. So this is the federal funds effective rate since 1955. So you can see what the Fed has done. Let's especially look at, so you see like the 1970s, right? Going into the not the Great Depression, but the 1980s. Everybody heard about the 1980s and interest rates back then. So you can see right here, the federal funds rate was very, very high. And then I'll show you the mortgage rates in a second, and you'll see how they kind of coincide with very high record mortgage rates back in the 80s. And then, they brought things down. You see what happened in 2000 with the dot-com crash. To avoid a complete meltdown of the economy, they dropped rates very fast after the dot-com crash to get things under control. They kept them right there about 1% for a while. Then they started increasing them again. You can see as soon as they started increasing them then, and we'll talk a little bit more about the real estate market and what happened leading up to 2008. But this was the 2008 housing crash. The markets had to respond, or the Fed had to respond to that to keep the world from going into a deeper and deeper recession and depression. So look what they did. They dropped rates basically to zero. And then if we look at a chart, since 2010, it's just been an unbelievable boom of all the markets. And a lot of that is contributed to because of what the Fed did here with zero interest rate environment. And not only that, but what else did they do during this time? They did a lot of quantitative easing, which is basically the Fed just buying assets onto the balance sheets of the Federal Reserve, which is crazy, but that's a whole different discussion. So they did a lot of that during this time span. And when we look at the price charts in a second, you'll see how during that time, just things skyrocketed. So you can see this going into, things started to go up. And then 2020, COVID hit, obviously. Again, they wanted to avoid a complete crash of everything. So they dropped rates back down to zero. And that's what saved us over the last 2 years. This is what dropped mortgage rates again, drove the housing market, quantitative easing going on again. The Fed literally buying trillions and trillions of dollars of assets and backing trillions and trillions of dollars worth of mortgage-backed loans and everything that they've done to avoid a crash. But what has that led to? It's led to record high lifetime inflation. It's led to record high housing bubble and stock market bubble and everything else that we've seen. And so, as you guys know right now, the Fed has been increasing rates 0.75 of a point at a time. It is not helping. Inflation is still record high. And this is going to cause the Fed to continue to increase rates. And again, going back to the correlation, that's going to continue to increase mortgage rates, continue to drive down the price of homes. I think that's when we're going to start to see some trouble pop up over the next 6 to 12 months, as a lot of us are already seeing right now around the country with the pullbacks, with the slowing of everything. Remember, the real estate market is a beast. Unlike the stock market, where you can have a sell-off happen in a day or two or a week or two, the real estate market takes time because a house has to get listed. So you're looking to list a house, what price to list it at. When we go to price a home, there's a lot that goes into it. And actually, this is good. Let me just talk about pricing a home for a second. Okay, so what is real estate worth? And if anybody wants to add anything to this, put it in the chat box, please. I'd love to hear your opinions on this. But so what is a house worth? Well, when we look at what a house is worth, we first have to know, we're going to look at what are called comps. But in an environment like this, we really have to look at who's buying and what can they afford. Who and where is very, very important also. But that's almost more from an investment side of things. And we'll talk about that in a second when we start getting into real estate investing. But just the basics of a house, what happens is you have to determine how much it's worth. So the way that most people do that is by looking at what are called comps, or a comparable market analysis. You'll hear it be called CMA. Another name for it on the commercial side is a BPO, which stands for broker price opinion. But basically, a comp is a comparable market analysis. So what we're looking at is other homes in the same area that are similar to the subject property to help us determine what our house is worth. So if I'm looking at a comp, I'm looking at, like, let's say it's a 3-bedroom, 2-bath, 2-car garage, pool home with, 1,800 square feet. If this is my subject property built in, let's say 1998, okay? So what I'm going to do is I'm going to pull up other properties in the neighborhood or in the vicinity that's very similar to the one where this property is. I'm going to look at the bedrooms, the bathrooms, the square footage, when it was built, the type of home it is. I'm going to look at all this stuff, and I'm going to look at what has already sold in the past 3 months, in the past 6 months, maybe in the past 30 days. So I'm going to look at that trend. Have similar prices been coming down? Have they been holding steady? Are they increasing? So that can tell me what I might be able to expect with this. Because if I'm looking at sold properties and the prices have all been dropping, if I look at 12 months, 6 months, 3 months, and 1 month, then I know that odds are the trend of this is going down. So the most recent properties that just sold are the most recent properties that are on the market. If the days on market have been a long time, then I know that I need to price my home less than those, or else it's just going to sit there as well, just like these ones are sitting because they're not selling. And listen, everybody thinks their home is special. It's not. People don't care about your special home. People look at this stuff. People look at numbers. Every now and then, maybe something that nobody else has, and it increases a little bit. But typically speaking, no. That's why real estate can be tough for people as individuals, because you get attached to a home. It's not a house; it's a home. And see, when we do investment property, we need to look at it as a house. We need to look at it as an investment. Take the emotional stuff out of that, okay? And we'll get into that. But so this is what we start looking at comps. and what the market's doing. And this is going to give us trends as to show us to what's going to be happening. But my point of all this is, once I determine what the house is worth, then I list it for sale. Then I start showing it. Then I have to put a contract on it. Then I have to close on it. This takes time. In the last 2 years, the list to show, to contract, to close has been the quickest I've ever seen it in my lifetime. People in the last 2 years have been buying houses sight unseen, cash deals, 15-day closings. If you weren't doing that, guess what? You didn't get the house. That's the bottom line with all this. Do you guys agree with me on that? So don't think that the last 2 years are normal, please, because that's not how most real estate markets work. That was an anomaly thanks to the Federal Reserve and everything that they did with zero interest rates and quantitative easing and pumping trillions into the markets. But that's not normal. Normally, you list a house, show it, put under contract 30 to 60 to 90 days. This is a strong market. This is more of a common market, about 90 days, okay? Right now, we're starting to see this go from 7 days on market. So these days on market, again, the last 2 years, anywhere from 0 to 7. Right now, we're starting to see more like 30 to 60. And I'm starting to see more and more properties sit 90 plus days. And somebody mentioned it earlier, we're starting to see these price drops along the way, right? You guys seeing that too? So this takes time. So if we're looking at comps and what they sold for ultimately, well, because looking at the market, this is going to give us the trend, but when we actually need to see value, it's what it's actually sold for. So by the time all of this happens and this sold price actually closes and then gets recorded at the courthouse, where now it's an official closed property, it takes time. This market that we're seeing trending down right now might not have official lower housing prices for 90, 120 days, 6 months sometimes, by the time we get to this point right here. Even before we get to the list and the person buying that house, you know, the buyer of that thing has to get a mortgage. So this entire time, if they're looking for a certain price at a certain level because the mortgage rates are lower, but all of a sudden the mortgage rates are climbing up, and if they weren't locked in, if they've just been looking or whatever, well, all of a sudden they're looking at $300,000 homes, but because mortgages now are much higher, they can only afford a $200,000 home. Well, guess what? What they were looking at before, they're no longer making offers on. So it's just going to continue to drive things down even more and more and more. And again, this all takes time. So this person that's starting to look, that's a ways out before they start actually seeing the effects of this housing market. So with mortgages, we can see that instantaneously. With the stock market, we can see those drops instantaneously. With the real estate market, it's what we consider a lagging indicator when it comes to the economy. And the reason for that is because of all this right here, because it takes so much time for all this stuff to happen in real estate. So as we watch the Fed funds rate to continue to increase, that's what we're going to keep our eyes on, is how's it affecting everything else within the economy and the markets, and especially in this case, real estate. And I'm going to talk again more in just a second why real estate right now for every single one of you on this call, no matter where you are financially right now. We're going to talk about that in just a second. All right, so share this. All right, so this is the 30-year fixed mortgage rate average in the US. So again, if we look back to the 1980s, remember I showed you before the federal funds rate was record high then? We'll look at the mortgage rate. It also follows right along with it. Again, that's how the Fed fund rate works as far as with the banks, so they mimic that often. So you can see it's come down over the years. Again, in 2008, you know, we had a pretty good, so you know, everybody always says that the bubbles are different between 2008 and today, and that's absolutely right. Things are driven by different circumstances, but it doesn't mean that it can't still be a bubble. It's just different the way that it happened. And we're starting to see more of what happened in 2008 happening right now that led up to the crash. But check this out right here. Mortgage rates were decent. I mean, mortgage rates were about where they are today leading up to 2008. But the reason why we saw a lot in 2008 happen was because of greed. The banks got very, very greedy. And let me show you one more chart, and I'm going to show you what the banks did, because they're starting to do more of it right now. And this is the part that kind of scares me a little bit too, is, all right, so this is the housing prices. You can see it's been a nice, slow, steady climb of housing prices, you know, over the last 50, 60 years. And then you can see when the banks started doing a lot of this wacky stuff. It started happening in about 2004, 2005, did it for several years. Then obviously it peaked in 2007, and then we had the 2008 crash. But look at that crash. Like, it wasn't even that much at the end of the day, if you think about it, when it comes to medium house prices. Now, I know a lot of areas were hit a lot harder than others. Certain types of real estate was hit a lot harder than others. So the effects were felt more by more people than just looking at the averages. But look at this. I mean, boom, we had this huge bubble burst because of what the banks were doing. Then when everything crashed, it came down. The Federal Reserve lowered rates, did all the quantitative easing in 2010 that I just showed you. And that allowed, because of that, instead of the markets coming back to a nice natural, maybe right down here, where they probably should have been before they started all the effery back in the early 2000s, should have probably come back down to here to even the markets out, to allow more nice steady growth into the future. Instead of doing that, they printed all the money, they reduced the rates to zero again, they did all the quantitative easing, and it sent the market basically into another bubble. And then that just was exasperated in 2020 with COVID, and boom. I mean, look at that hockey stick at the end there. It's just unbelievable, because they just did what they had been doing and just put fuel and fire on top of it and just blew it up. If this was this then, and that was like, people talk about how it was the worst housing crash ever, and that's all it was, what are we going to see here, guys? What are we going to see here? You tell me. I mean, so that right there is what makes me think that we're going to see a pretty bad crash happen. Dexter said a repeat of 2008. I think it could be worse. And again, guys, I'm not here to be the doomsdayer, because I'm going to tell you exactly how you can take advantage of all this in just a second. But I just want to show you, like, this is what we're looking at right now. This is what I see. This is why I'm going back into my financial library and getting out my foreclosure books, my short sale books, my how to work with the banks books for buying real estate, because this is where we were able to get so many good deals back in 2010, 2011, 2012. How many of you bought real estate in 2010, 11, 12, 13? Investment real estate. Okay, so several people. How many of you have sold some or all of those properties in the past couple of years? Put sold. If you sold any or all of them that you bought in the past couple of years, put sold. A whole lot of you. Okay, all right. So same thing. My business partners, same thing. My people, same thing. Chris Naugle, same thing. You guys all know it. He's been talking about it for 2 years. He's been selling everything off. All right, why? Because 2008, one more time, I just showed you the charts. Things came down. We knew when things came down, they were going to come back up. 2010 to 2012, as this market was going up, this is when we were buying. And there's multiple reasons why we were buying them and how. So just naturally, the whole housing market came down. But in reality, the best buys were foreclosures and short sales and direct from the bank, and getting people out of foreclosure situations, because those properties, while the whole real estate market naturally came down, these deals right here were bought at the very lowest prices, way below average. And that's when you can make money in real estate. That's one of the great things about real estate, is there's a big difference in the retail market and the investment market. And the best thing about it is you, me, anybody can take advantage of it. Stocks, the stock market, you have these ups and downs of the stock market. You have your retail investors that are buying, and then you have your institutional buyers, like the big hedge funds, the big Black Rocks and people like that are buying. Well, guess what? Those big brokerage houses, those big, huge hedge funds, especially the hedge funds, they have no regulation. And so they're able to go in and they're able to buy the stock market for way less than what you as the average buyer can do. So when the market crashes like it does these days, guess what? These hedge funds are making millions of dollars and you're losing millions of dollars, because by the time you react and you sell or buy during this time, they've already bought and sold several seconds or minutes before you. And that several seconds or minutes is what makes all the difference. And there's nothing you can do about that. That's just the way that the stock market's rigged. You guys can read all about this stuff. Michael Lewis wrote a pretty good book about it called Flash Boys. Flash Boys was a pretty good book I read about the electronic trading and the computer trading and everything that goes on these days. Really anything by Michael Lewis. He's one of my favorite authors, by the way, guys. Michael Lewis, when it comes to storytelling for the financial industry. So that's that. But when it comes to real estate, we can do this just like the big guys can, period. we're involved in deals right now with Private Money Club that we push the big guys out of the way to fund instead of them. Why? Because the borrower would rather work with us individuals than those big hedge funds, because nobody loves hedge funds, right? They take advantage of people. They don't. Government started. All right. So we're buying. So we're able to buy lower than the average market as well. So there's so many advantages to real estate and what we can do with it. And then what happened over the last 10, 12 years as prices went up? If you bought right, well, we'll talk about that, different types of ways to make money in real estate in a second, because that's important. So we made money multiple ways over this time span. Cashing out, it sounds like a lot of people cashed out up here. Now they're keeping their money moving through maybe more passive stuff, or maybe other means of investing. And then if you're smart, like we are, we're ready to get back in. So as soon as we start seeing these prices come down and we start seeing these buys be had, we're going to start buying back in and doing what we're doing in this market to make money in it. So I'm super, super excited about what's happening right now. And that's what I want to get into next, is how all of you can be part of that and how you can take full advantage of what's going on and what we are going to be doing over the next several years. So let's talk specifically about real estate for a minute. Okay. So like I said before, and you guys have heard me say this before, the stock market, you can have an Enron where you have somebody that was scamming money and ripping people off, and the CEO was some scumbag, and you can have these Bernie Madoff characters out there, and you can have all these different issues with the stock market. I mean, you see these companies, what was the one that just recently got involved with all the woke stuff and people, PayPal is a online bank essentially. And PayPal came out with a policy that said, if you spread what we determine is misinformation, or if you share stuff online that we don't agree with, we have the ability to fine your PayPal account up to $2,500. And so people were like, well, what the hell? No, you're a bank. You have no right to tell me what I can do online and fine me up to $2,500 for it. So a bunch of people closed their PayPal accounts and dropped their prices down. And you see this over and over again with some of these companies where they try and get involved with these social issues or political issues or whatever the case might be. And all this stuff happens and whatever. Like, so stuff that I have no control of. Like, how do I know what this company is going to decide in their policy? Or if you just look at, just financial decisions, like they have the board that's making decisions, but what if there's somebody in there that has an ulterior motive? Like, and now we have all this ESG stuff out there, the environmental, social, and whatever policy. And it's just crazy what's happening with all these big corporations and companies right now. And again, so I'm investing in these things in the stock market, but I have no control over what's actually going to happen. I'm basically riding that wave. Now, when it comes to stocks, if I feel like I want to take advantage of different markets, then I can learn about options trading and shorting stocks and puts and things like that, where you can make money in a down market. But the risk on that stuff, at least that I've always learned, is very, very high. There's a lot of risk involved. Now, I know we can do different spreads and naked calls and all these different things to protect ourselves on downside protection. But at the end of the day, that's a whole lot of stuff that I personally want nothing to do with. I just don't love it. And there's better alternatives, in my opinion, out there. So then what I do is I look at, okay, well, what is that? So let's look at real estate. Well, first off, talk to any multimillionaire, talk to any super wealthy person, talk to any billionaire, and I guarantee you they are bullish on real estate. They own a lot of real estate and they believe in real estate. I guarantee it, every single one of them. If we look at the banks, we all agree that banks know how to make money. Number one, banks put their money in life insurance. It's called BOLI, bank-owned life insurance. If you look at banks' M1 money supply, something like over 90% of it is either in life insurance or real estate. So again, we talked about this last week. Life insurance is becoming our own bank, especially design engineer policy that we run our money through to get all those advantages. And then real estate is what the banks are buying. Banks know how to make money. So banks are doing those things, then it makes sense for us to. One other great example is McDonald's. I learned this a long time ago, and I've always found it fascinating, but McDonald's doesn't actually make their wealth through hamburgers, through flipping burgers. McDonald's actual value and the way that they have made billions of dollars is real estate. See, there used to be a saying that McDonald's flips burgers to buy real estate. And if you look at what McDonald's does, the franchises do, is they own every single piece of land that McDonald's is on. And in a lot of cases, what McDonald's did is they went around and they would do these surveys. Okay, which intersections around the country, or which intersections are the most busy? Where would a fast food restaurant be the most beneficial? And then what they do is they would find that land for sale and they would buy it where the McDonald's goes. But not only would they buy that land, they were very smart. McDonald's would buy the land on every section of that intersection, every corner of it. So you'd have a McDonald's here, you'd have a Burger King here, you'd have a Taco Bell here, you'd have a Wendy's here. Guess what? McDonald's actually owned the land, the real estate that all of those franchises were on. So you'd be like, well, why would McDonald's want to put a Wendy's franchise across the street from them? Because McDonald's doesn't give a shit. McDonald's has that there in the first place to buy the land. So they're very smart about that. And I always thought that was fascinating. And when you really dig into wealth and you dig into, how millionaires operate, you're going to find more and more real estate. Think about the three wealth killers: volatility, inflation, and taxes. Well, if you look at taxes specifically, real estate is probably, and I'm not a CPA and I don't know this as a fact, but I believe real estate is probably the most beneficial thing that you can own to save money on taxes. Would you guys agree with me on that? Those of you that own real estate, I believe that real estate is the most beneficial thing you could ever do for yourself financially if you want to pay less money in taxes. The amount of write-offs that are available for real estate and the way that you can structure things using a good CPA when it comes to real estate is just unbelievable. The depreciation that you can take from it. And it's not only in 1 year, you can appreciate real estate for like 30 years. It's pretty wild. You can carry it over. Like there's so much you can do with it. And so we're eliminating that wealth killer there. Volatility, inflation. Again, these strategies I'm going to show you, we eliminate it right there. Inflation. I'll circle back to inflation and volatility in a second, but we're eliminating volatility and inflation with real estate, plain and simple. So we're getting rid of those three wealth killers with one technique, and that's real estate. Yeah, Robert Kiyosaki, Morgan, a lot of what I do and a lot of what I honestly teach on these things definitely came from Robert Kiyosaki. I always say I was very lucky to be able to meet Robert and work with his company when I was just getting started in my 20s in all this stuff. And he just taught me so much. So yeah, I love it. Chris said it: real estate, infinite banking, gold and silver, key investments to build and maintain wealth. I agree with you 100% that, Chris. And if you notice, Chris, that's exactly what we teach. Like I said last week, or the Money School Foundation, real estate, infinite banking, and legacy. And gold and silver definitely can fit into all three of those as well. In different ways. And we do a gold and silver training once a week. We did take like the last month off because I was traveling, but we are going to start that gold and silver weekly training back up in the next week or two. I just got to look at the schedule, but that is coming again, especially right now in this market. I think gold and silver is a cool place to look at for storing some wealth. So those are some reasons why I love real estate, because it just checks so many different boxes for what we need to accomplish when it comes to building and preserving wealth. So let's talk about that a little bit more now. So what are some different, well, first off, before I get into the types of real estate, what are the two different types of real estate investors? Because as I get into the types of real estate, I want you to think about to yourself, which type of real estate investor am I? Active, passive? All right, typically speaking, an active real estate investor is going to be somebody that doesn't necessarily have a lot of money right now put away, okay? Meaning they're at a point in their life, maybe you're making good money right now, but you're building wealth. You don't have a whole lot of wealth already built up or put away into savings or into IRAs or banking policies or something of that nature. So you know that you need to actively go out there and do types of real estate to make big chunks of money to bring back in to start building your wealth. And then there's going to be a middle ground here too. Typically, a passive real estate investor is going to be somebody that has money, that has wealth, and they're looking for safe and smart places to invest that wealth, to put that money, to grow that money, to make more money and more wealth for them. Typically, an active real estate investor has time, passive no time. So clearly, if let's say both of these people have a job. If this job, you're barely getting by, you're not able to save a lot of money, you're falling into some debt, whatever the case might be, well, then it's very important that you do everything you can to change that situation. And the only way to change that situation is to be smart with your time and to honestly hustle. You got to go out there and do what other people aren't willing to do. When you get home from work, instead of turning on the TV or doing whatever you do typically, maybe you're opening a book, maybe you're making some sales calls, maybe you're following up with some leads, you're doing something to actively go out there and generate more business because you have to. There's not another option if you want to get out of the rat race or the situation that you're in. There's nothing wrong with it. This is just the facts. So typically you're going to have the time, or you're going to have to make the time to be able to go out there and do this kind of thing. Where the passive investor, they typically either just don't have the time because their business is so busy, or whatever they do for a living, they're making good money, they're saving it, they're putting it away. They just don't have extra time to go out there and actively do the work needed to actually do real estate investing. But they know that they still want to take advantage of the real estate market. So we'll talk about a couple of different ways that they can do that. And again, take advantage of not only the real estate market, but everything that goes along with it, like taxes. All right. So am I missing anything else here? Does that make sense right there? The difference in an active and passive investor. So do this. Actually, if you don't have any questions, put it in the chat box. Which one are you primarily, do you think? Do you consider yourself an active investor or a passive investor? When it comes to real estate, these are going to be things like wholesale deals, flips, developments, apartments, for example. And in the passive side, we're going to have private money lending. We're going to have private funds. We're going to have kind of in the middle of these two, we're going to have rentals. Just to kind of go through this real fast if anybody's new on here. So if you are the kind of person that needs more money, you're actively looking to go out there and do something different to change your financial situation, I would highly recommend starting with wholesaling and flips. Notes can go either way. We'll talk about a couple of these too. All right, so let me get into this. So wholesale and flips. So wholesaling, what wholesaling is basically you're the marketing and negotiation arm for a house flipper, is basically what wholesaling is. Because what wholesaling is, you find a house that's a good deal, and you put the house under contract for whatever price, but instead of closing on this property, before you close on it, you're going to sell it to a flipper. You're going to sell the paper. So you identify a house that's a good deal. You go to negotiate the deal. You put the deal on the paper in the form of a contract that says you're going to buy the property. But before you actually buy that property and go to closing, you're going to take that contract and you're going to sell that deal. You're going to sell that contract to another investor. And that wholesale deal can range anywhere from $2,000 to $200,000, depending on the deal. Very common to see like $5,000 to $10,000 to $20,000 wholesale assignment contracts done. So that's what wholesaling is. The good news with it is it doesn't take a lot of experience. It doesn't take a whole lot of time once you get your marketing in place. And it doesn't take a whole lot of work, really. So if you're somebody that is looking to do like a side business, kind of learn real estate, learn marketing, get into this, make some extra money without having to really build entire teams for flips or really get into some of the more complicated stuff, wholesaling is an excellent place to start. And you'll see a lot of investors start with wholesaling and then they get into other areas of the business. I've done wholesale deals in the past when I was just getting started. To just give you an example there. And then the thing beyond that, probably the next place to go as a real estate investor after wholesale deals, or maybe find some wholesale deals that you want to keep and do yourself, because you know that you're going to make $10,000 on the wholesale deal, but you know that flipper is going to make $50,000 flipping it. So maybe you say, well, instead of 10, I want to make the whole 50, so I'm going to keep this deal and do it myself. That's what happens for a lot of wholesalers eventually. So a flip is when you take a property and you redo it. You drive the value up. So you fix up the kitchen, or you redo the floor plan in the house, or the floors, or the roof, or whatever you got to do to fix that house up. You guys have all seen the house flipping shows. So that's a real estate. That's a real estate flip. And then you'll hear one other term I'll mention, which is called wholesale. So a wholesale deal is kind of a mixture between a wholesale and a flip. And because you do close on the property, but instead of doing like a whole rehab on the thing, like a whole entire flip, you might just go in and put some paint on the walls and then turn it over real fast. You might not do a whole lot of work to it. So that's what we call a wholesale deal. And those get done very, very quickly. Some other areas of active real estate, we could start looking at development. So developing single family homes or communities or neighborhoods, or even just single residential homes. So we can get into development. You can start getting into apartment complexes. There's a lot of real estate investors that they'll start getting into affordable housing and apartment complexes where they go in and they buy, 100-door apartment complex, and they go in and they fix it all up and they do what's called value add. So they drive the value of it up, and they do things like put in LED lights and low flow plumbing fixtures and drive expenses down. So what they're doing there is they're increasing the cap rate. They're increasing, they're allowing the property to be worth more money and increase the rents by making it nicer, at the same time decreasing the cost and expenses into running that apartment complex. So they go and they do these value adds on these big apartment complexes and do real estate that way. But there's a whole lot to that. But guess what? The basics are the same. Wholesaling, you learn how to market, you learn how to identify good properties. That's going to be used in apartment complexes. In flipping, you're building teams of contractors, people that are going to actually do the work for you, and your network, what we call a power team. So in an apartment complex, you're going to need those exact same people, the connections to get this stuff sold. And all of that. So it all comes together. It's just, what area do you want to go to? What area right now are you focusing on? Well, and then let's go over to the passive side. Okay. So maybe you have money and you want to be smart with it. You don't want to deal with the stock market like we talked about and all this. You want to get in on this action, but you don't want to actively actually go out there and do it. So this is what private money lending does. I can find somebody that's doing flips over here, that's doing developments, that's doing apartments, whatever. Let's just say flips. I can find somebody that's doing flips over here. When it comes to flips, what do you need to do a house flip? You need money. What did I say that this person probably doesn't have a lot of right now? Money. So they're leveraging what they do have to be able to obtain these properties. The way you typically leverage money to buy real estate is through a bank. A bank is going to give you the loan. You'll be able to go out there and do it and pay them back. But banks get a little bit picky when it comes to investment real estate. So they get to a point where they either won't stop, they'll either stop lending you money because you've hit your debt to income ratios or your leverage ratios or whatever you're doing. Maybe they've already lent you too much money on other deals. Whatever the case might be, you just don't qualify. Right now, the banks are really restricting and tightening up. So the whole process is just more of a pain in the ass. So whatever the case might be, banks also take a long time to get a loan to you. And when you're doing a flip, and you identify a good deal or even a wholesale deal, when you identify a good deal, a lot of times if you're not able to close on that with cash very fast, that deal's gone. It's going to go to another investor. So we need that money fast, and we need the money, period. So the bank's dragging its feet. They're making it harder. They're not getting us the money when we need it. They won't give us the money anymore because we're already overextended according to them in their eyes. The only other way to get more money, to do more deals, to be an active investor, is to look at things like hard money and private money. So if this guy's got the money over here and this guy's got the deal over here, doesn't it make sense that they could connect and get that deal done? Absolutely, right? And we'll talk about in a second what that actually looks like, the protection in place to make sure that this person's protected and this person's protected in this deal that occurs. And private lending is what we do through Private Money Club. So I'll bring up Private Money Club in a second and talk to you a little bit more about it. Then we have private funds. So somebody mentioned a REIT a minute ago. A REIT is called a real estate investment trust. REITs are typically public entities. So if you have like a broker, like a financial advisor, Fidelity account, something like that, you're going to see REITs that are available. These are big real estate transactions, often developments, commercial real estate, but they're public offerings. So it's basically going to operate the same way that a stock market does, that the stock does. I don't like REITs. Okay. There's a lot of fees typically involved with them. Your actual returns are much lower. There's such massive projects, and a lot of times you don't even really know who's involved with them. I just don't love REITs. They're too public. I prefer the private controlling my money every single step of the way. But it's similar. A REIT is similar to a private fund, though. Private funds are pretty popular with apartment complex value adds because a flip. You can do a flip anywhere from $100,000 to $500,000. So a single private money lender makes a lot of sense. A value add apartment complex might be $20 million. So for one investor to be able to fund $20 million is tough sometimes, a lot of times. And so what they'll do is one of these investors will put together something like a private fund or a syndication. You'll have syndication quite often as well, where they can pool people's money together. And then that pooled money can do that apartment complex value add and everybody can make money on it. So you'll see syndications, private funds on the passive side, notes. So note investing is where you're buying and selling existing mortgages, existing notes. Notes can be passive or active because you can actually buy and sell notes to make money. You can buy a note, keep part of it, sell the rest of it off, where you have long-term money and now money, or you can just buy notes and forget about them for 30 years and let them pay you. So they can be passive or active. Rental properties, same thing. Short-term rentals are typically going to be a little bit more active than a long-term rental, depending on where it is, depending on the type of rental it is. All that stuff is going to kind of determine, is it an active or more of a passive investment? Most people that own rental properties are going to tell you it's a lot more work than what they thought it was going to be. Even with a property manager that's eating into all your profits, it's still tough. But rental properties offer so many advantages. It's one of those things you almost have to do. And you can do private money lending on rentals also, don't forget, long-term deals. We have there's deals in the private money club right now that are 5, 6, 7-year terms where you can ride that out. Yeah, Robin, there's books and websites. We do trainings on it every single week called Money Club Mondays. There's a lot of education if you go to privatemoneyclub.com. And then for registering for this event, we should have sent you the book. So we sent you a digital copy of Chris's book, the Private Money the Private Money Guide, Real Estate Edition. So you should have a digital copy of this book just for registering for this webinar. If anybody doesn't have that and they want it, just shoot me an email and I'll send it over to you. All right. But yeah, we have lots of resources. And again, privatemoneyclub.com does have some education and training on there also about all this. All right. So let's break this down even a little bit more. When I look at real estate investing, whether it's active or passive, I'm going to focus on what is good for the market that I'm in right now. And I that does change over time. Okay. So let's list out different types of real estate that we can be part of and invest in, either actively or passively. And then let's talk about which ones of these might be smart to be looking at in this market today compared to 2 years ago, compared to 2 years from now. Fair enough? So we have single family homes, single family residence. So these are your typical houses. Then we have what are called multifamily. So multifamily is going to typically be anything from like 2 to 4 units. So duplex, triplex, quadplex. So you have your single family home, you have your multifamily residential, which is 2 to 4 units, and then anything 4+ units, commercial. 2 to 4 is residential multifamily, 4+ units is commercial multifamily. So these are things like apartment complexes. So we got new construction. New construction can consist of single family to anything like neighborhoods. And then is the new construction being built to sell the property or to rent the properties that are being developed? So new construction / development. So land kind of goes into eventually we're going to do something with it. Unless you're just flipping the land, which is fine. What else? Number 6, we got like storage units. How about that? How about RV parks? Right? VRBO. So typically your VRBO is going to be kind of up here, a single family. So a single family, we have 3 options: sell, long-term rental, short-term rental. So within the category of single family home, not only do we have that, but we have the options of, as an investor, is the plan to sell that property, to rent it long-term, meaning like 1-year leases, or to do short-term rental like VRBO or Airbnb. What we've seen over the past couple of years, especially, let's just talk about the last couple of years, is in a single family home market, have we seen an increase or decrease? Well, we already talked about, we saw a huge increase in prices. And then now recently, we're starting to see a pullback. Multifamily, same thing. Commercial, same thing. New construction, same thing. Prices of everything have skyrocketed. What I want to do is I want to say, let's say if things do crash, if things do really, if the shit really does hit the fan, as they say, okay? If that happens, where do I want to be right now? Or where do I want to focus on to be able to make the most money in the real estate business? And this is why I love real estate, is because you can make money in down markets like this. Think about what happens if the market crashes, if the economy goes into a recession, what's going to start happening with real estate? I don't care what kind of real estate it is. What are we going to start seeing happen on the market? Okay, foreclosures, right? We're going to see a lot of foreclosures. Price drops. How about less buyers? We're going to see less buyers. If we're in a recession and nobody's working and nobody has extra money, we're going to see less buyers, right? Yeah, definitely a buyer's market, Chris. That's for sure. But I'm just saying, like, what are we going to see happen? All right. So from what I saw happen in 2008 and what I believe will happen now is I think that we will see a lot of foreclosures. I think we're going to see price drops. And I think we're going to see less buyers driving prices down even more. And so what does that actually mean? So Blaine said new renters, absolutely. So if I know that this stuff's going to happen, okay, if I know this stuff's going to happen and I'm an investor, what am I looking for? Let's say I'm on the passive side, or it doesn't matter if you're on the active or passive side. What are you looking for as an investor if you know this stuff's going to happen? Okay, we just don't know when it's going to happen, especially the price drops. You know, we don't know how fast or how soon that's going to happen. So what are we looking at? All right, so if we agree that's going to happen, does everybody agree with me, or does anybody want to add anything, or does anybody disagree with me? So let's talk about the different types of real estate that we can do again now. All right, so let's start with wholesaling. If you're a wholesaler and you need to go out there and make money, what do you think you should learn how to do right now? You want to learn how to market to distressed homeowners. You want to learn how to start generating leads for people that might be in some financial trouble, that might need to sell, that might need to get out of their house, that might be approaching foreclosure. So you need to learn how to market to those kinds of people. You need to learn how to negotiate, and you need to learn how to work with the banks. To me, this is the market, because if we have foreclosures, you're going to want to be able to work with the banks. You're going to want to be able to find those sellers. If we're seeing price drops, you're going to want to see who's in trouble, so you know how low you can go with your pricing. You can go in and say, listen, the market's coming down. You guys see this happening. You need to get out at this point. How about we agree at this price right here, whatever the case might be. And if there's less buyers in the market, then again, you're going to want to be able to determine how to get those deals, because those sellers are going to be looking for those buyers too. But if you can find those sellers better than these buyers can, then you're going to be able to be the one that gets the deals. And this is true for flipping too, for flip. So if you're acquiring real estate for any reason, those are some things that I would start looking at right now, especially from the active side. Now, if you're a flipper, what are you looking for if you're a flipper? Or if you're a wholesaler, what kind of properties are flippers going to want to have in this market right now? Would you agree that like a wholesale deal or a quick flip might be a good place to be? Okay, because think about it. If you buy a house, say you buy it for $250K rehab, but this is going to take you 12 months. You expect to sell it for $300, profit $50K. All right, I understand that's not how this works, but just follow me here. $200,000 purchase price, $50,000 rehab, 12-month rehab on the deal. It's a big rehab. They're redoing the entire thing everywhere all at once, and the profit's going to be $50,000. $50,000 profit sounds great, right? But what is the problem with this? 12 months. What can happen in that real estate market in 12 months? Well, that $300,000 ARV after rehab value, after repair value, how do you get the ARV? Through comps. What did we talk about before? Are comps instantaneous, or do comps take a long time to be able to figure out what the house is actually worth? It takes a long time, right? So if we're using comps to determine the ARV today at 300,000, but 12 months from now, the market's continuing to drop, this ARV might be 250 now. And if we can only sell the house for 250, we got 250 in it, well, guess what? We made no money on that deal, and it took us a year to accomplish. So anything longer term when it comes to flips, maybe now is not the time for that, okay? And if you're an active investor, this is good. Or if you're passive, is this important to know if you're passive? If you're someone that has the money and you're looking to lend it to somebody that's actively doing the deal, well, guess what? You need to know this too, because you need to understand, where is this located? What is that market like? See, if this is Florida, maybe I feel a little bit better about that than if this was New York. Why? Because Florida's trending much stronger right now than New York. And that probably will continue. So the location matters as well. Something else you want to consider: price of the home, the type of the home, okay? You know, people that bought houses, let's say $300,000 to $500,000 over the past couple of years, you know, maybe they really stressed themselves to get to that higher price point, whatever the case is. Maybe they, you know, everybody's making a bunch of money and everybody's doing great, and they thought that was going to continue forever. And then all of a sudden, you know, they were a mortgage broker making all this money, and now there's no mortgages anymore, so they're making zero money, or whatever the case might be. Real estate agent. You see these tech companies are just cutting job after job, hundreds of thousands of jobs. These tech companies are cutting right now. And a lot of people are saying it's going to get worse and worse. Jeff Bezos just came out today and said that he's expecting now's the time to really batten down the hatches, because we have really tough economic times coming. So Jeff Bezos saying that, which I'm sure he's looking at that with Amazon, saying, okay, how many layoffs are we going to need to do and all this stuff. So what you thought you were happily paying back then, well, guess what? If you can no longer afford $500,000, plus mortgage rates are sky high, making you afford even less money, and you got to sell, or you get into a foreclosure, or whatever the case might be, well, you still need a place to live, right? So anytime that I see a market like we have coming, where this stuff could easily happen and could happen quicker than expected if things really start going like that, well, I don't want to be stuck in the middle of a big deal. I don't want to be looking at these $1 million houses. I want to be where people are going to be, the general public. And to me, that's one area, that's affordable housing. Affordable housing has been and always will be one of the bread and butters for a real estate investor, because we can do single family homes, we can do duplexes, we can, you know, single family homes at the lower economic prices, not the upper to middle class, but your middle class to lower class levels, even right in there. That's where people want to live. Even the people that stretch to be in the middle to upper class are going to have to fall back to that lower to middle class level of housing in the area, wherever their area is. So they're going to look at these kinds of things. Maybe they go into a duplex. You know, if they do have a foreclosure, now they can't buy another house, so now they have to rent. So we start looking at apartments. You know, one of the reasons why that chart, that real estate chart that I showed you earlier, that had the real estate market not coming down as far as you would think it would, because they're taking all real estate into account. Apartment complexes in 2008 crash barely lost any value at all. I think it was like 0.2% or something like that overall, where the overall housing market in places like Cape Coral, Florida, lost like 50, 60, 80% on a lot of houses. So there's a big range there on the types of houses. And a lot of those were the ones that the people stretched, the market went way up and then it came right back down. Is what happened in a lot of the country. But then you see those apartment complexes that held their value. Why? Because people still needed a place to live. So they still needed to go in there. And so those prices pretty much stabilized because of that, because of the changes that happened. So these are things that I'm looking at. Be quick with it. And then what we can do is we can use our experience, if you have it, if you've been through this before, if you've learned it, if you're working with a mentor or somebody that has before, to be able to take advantage of this entire situation and do what? The whole goal with all of this, guys, the reason I'm telling you all this is for one reason. It's what Warren Buffett says: buy low, boom, sell high. So how do we sell high? Well, we either buy low enough and we let the market ride it, or we buy low enough and we drive the value up through rehabbing the property, just like we just talked about. Whether it's single family, whether it's a quadplex, whether it's an apartment complex, whether it's a mobile home park, whether it's an RV park, all we're doing is we're buying that real estate at a discount, because we know what we're doing, we know how to do that, and we're driving the value up, and then we're selling it with our exit plan. So you want to buy low, sell high, and don't lose money, obviously. Sounds easy. So we got to have those exit strategies. I would be willing to say, when you find an investor that knows how to buy low and they have multiple exit strategies, you found a good match. So if I'm looking to lend money and I'm working with an investor, I'm asking them these questions. Have you been through this before? Do you have a plan for this? What are you looking to do? How are you going to be able to buy properties low? What is your plan? What's your exit strategy for these properties? How do you know you're going to make money on them? These are all little things that I'm asking. And a lot of this just boils down to experience. How can you actually start taking advantage of this, no matter what side of the fence that you're on? I'm ready to take advantage of this, and I hope you are too, because again, this market right now, I think is going to be better than what happened in 2008 from an investment standpoint. It's going to be terrible for the American people in the country, but from an investment standpoint, we're gonna take advantage of it, and we're gonna make a lot of money in the process. And not only are we gonna take advantage of it, but we're gonna help people along the way. Because when I told you I was cleaning up on foreclosures and short sales and how to work with distressed sellers, is because one of the reasons we do what we do is because we can help those people. We can go in and we can negotiate with them, with the bank, to get them money. So when they move, they have money to move into a new place. Or maybe we negotiate with the bank where they don't have a foreclosure on their record, where we can take that property over. Or maybe we just help somebody, find somewhere else to move to, or provide that housing for them, or provide them through an exit strategy with a lease option or a seller finance property where maybe they couldn't buy before, but now because of us, they can buy. So we're going in and, if you look at some of the foreclosures that happened in 2008, 2009, 10, a lot of neighborhoods were just run down and destroyed, and crappy properties, and a lot of crime. And guess what? It's investors like us that went in there and bought these properties up and fixed them up and brought the communities back to life. That's what investors do in down economic times. So just remember, everything that I talk about is through the lens of not only being successful and making money, but also helping other people. And I think that's a big part of real estate and what allows you to stay in it for the long term. So those are my eyes when we're looking at these different types of deals. So how can you get started with some of this stuff? I'm not going to get into all of it. I'm just going to show you 3 different options right now, things you can take action on right now today to get started. You can join us for the Money School 3-day training. It's $297 for 3 days. But the reason I want to bring you there is if you're new to all of this stuff, it's going to give me Chris and I and a handful of experts, 3 days to spend with you to really dig deep into everything that I've been talking about last week and this week on Wealth Webinar Series. So it's $297, but for being on here right now, I'll give you $100 off, so $197. Okay, that's for all 3 days with the recordings and everything like that. And again, Justin Colby's going to be on, I believe. Kevin Shortell will be on. Matthew Sullivan will be on. But these are some of the top investors in the country that are on our 3-day teaching you this stuff in depth that I've been going over today. Number 2, we have the Private Money Club, $997 a year for 2 more days, and then the price is going to go up on Saturday. So if you want to get into Private Money Club, it's just privatemoneyclub.com. Again, Private Money Club, it's the active person with the passive person, and it combines them together. So if you're looking for money for your deals, or if you're looking to lend money on deals, Private Money Club is the place to be. And again, there is some education on there, how you can start evaluating these deals and looking at them and all that good stuff. There is some work involved, especially on the passive side, because you got to go in, you got to build the relationships, you have to find the deals, you have to underwrite them, make sure they look good, get the stuff done. But once you lend the money, then it's kind of sitting back and letting those interest checks come in until the deal is done, and then you move on to the next one. Again, if you have money, that's great. It'll be a great place to access it. So definitely privatemoneyclub.com. Number 3 is the last thing that I wanted to mention. There's no charge for this, but it's a great opportunity for a lot of you, so you don't want to miss this. It's called Inicio Capital. So the Inicio Capital Fund is kind of a done-for-you fund that myself, Chris Naugle, Greg Hurling, Justin Colby, Kent Clothier, and a few other of the top real estate investors in the country are partners in. So the Inicio Capital Fund was put together over the last month, and it went active this last week to start raising money. And the Inicio Capital has one goal, and that is to make money in this real estate market, and a lot of money. We've put together, like I said, some of the top real estate investors that I've met that not only have made millions and millions of dollars in real estate here recently, but have been through 2008. They've seen it happen, just like me. They know exactly what to do. They've had the practice. They bought the real estate during that time and leading up to where we are today, and we're ready to go. So we're ready to source all of our resources together, all of our education, experience, and knowledge together in this fund, Initio Capital Fund. And we are looking for money. So anybody that, kind of has the idea of, I love the idea of learning this stuff myself. I love the idea of going in and finding my own deals. Maybe I just don't have the time right now. Maybe I just don't have the wherewithal right now. The Initio Capital Fund is an awesome opportunity for you to consider. And I'd love to talk to you about it more in detail on a phone call, because we are aiming for strong returns. We're looking at paying out our investors in the high teens. Anything less annually, high teens annually returns. Anything less than that would be considered a failure. And if you listen to the group of guys that I just mentioned that are in this fund, including Chris Naugle, these guys don't fail. So we're looking to do some awesome stuff with it, and we're going to do it with your money and let you be involved with it through lending to us in this new Initio Capital Fund. So if you liked anything that you heard today, check this stuff out. I'm going to put some links in the box right now. And if you want to learn more about the Initio Capital Fund, I'm just going to have you send me an email, and that way I can send you some more information on it, and we can schedule a call to hop on the phone to talk about that. But that will be a great place. And it's a $25,000 minimum on that, just so you know. How much value would adding another, let's say, 2-bedroom, 1-bath apartment to a duplex be? It just depends, Cindy, where you are. How do I delete my PayPal account? Yeah, a lot of people deleted their PayPal accounts. Passive is greater than active. It can be. Passive investing is just different than active investing. And they both are just as valuable depending on your situation. Jim said, I like to buy and hold for rental, but in multiple markets, so my locations are diversified. Any good ideas on how to find the best contractors, trades, etc., new cities? That's a great, there's a lot of good resources out these days. Facebook groups, you're going to be able to meet local real estate investors that have those contacts. There's different online websites these days where you can look up tradespeople. Like Angie's List was used for a long time. I don't know if Angie's List is still a thing, but sites like Angie's List where you can find tradespeople, and it has their rating system and stuff like that. But local RIAs, if you can join like a local RIA, even virtually, a lot of local RIAs offer Zoom now as well, so you can join their community. But really just networking, Jim. Ask us. Maybe I know somebody wherever you're looking. But it's all about the network at that point, Jim. So we have a pretty strong network, so we can definitely try and help you with that by all means. All right, so this link right here is for the 3-day discount code virtual discount. So that's for the 3-day. Let me see, Private Money Club. Like I said, it's just privatemoneyclub.com. Private Money Club, again, is $9.97 a year for the next few days, and the price is going up to $14.97. There are still a couple slight little technical issues on Private Money Club. That should be worked out this week. But if you go on there now, just know that there are some technical issues that the tech team is fixing right now. And then if anybody wants to talk about Initio Capital, just shoot me an email and I will, I'll get with you so we can talk more about Marco. We don't have a website for Initio Capital yet. That should be ready in the next week or two. Like I said, this is brand new. We just launched it last week. And so we don't have any of that stuff out yet, but we will in the next couple of weeks. But we are already taking in money for the first deals. We have a few identified already. So super excited about that. And again, shooting for those high teen returns for you guys. And I'm just going to crush this market that we're in. And it's going to be a whole lot of fun. Again, James, if you need anything, any books, any lists or anything, just send me an email and I'll shoot all that stuff over to you. I just don't have a way of copying everyone's emails on here right now. And the 3-day, again, it's where you want to be if you want to just get really more in depth what we've been talking about the last couple of weeks and really digging deep on how a lot of this stuff works. And yeah, Chris Root will be there talking about mobile home parks. We have some people coming on talking about trusts and asset protection and taxes and different software. It's going to be full of awesome stuff. So yeah, the 3-day is November 11th, 12th, and 13th. All right, cool, guys. Well, I appreciate everybody being here today. I hope that this was valuable and everybody got a little something out of it. If you need anything at all, please just send me an email, snaggy@chrisnaugle.com, or whatever email you have for me. You guys know my number, 561-313-6213. I'm here for you. Looking forward to talking with everybody, getting you guys started in the fund on Private Money Club at the 3-day training. We have some new stuff coming out with the personal financial CFO for your life and some different stuff. So some cool stuff happening also. Look forward to talking with you guys. All right. Hope everybody has a great week. We'll talk with you soon. Thank you.
All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.